Welcome back, everyone. One day after the midterm elections, the Federal Reserve made an announcement that had a much greater immediate impact on the markets. It pledged to buy up to $600 billion in government bonds over the next 8 months. Mike Larson is back with us to discuss the implications of this second round of quantitative easing. And joining us on set with his thoughts is Steve Chapman, an investment advisor and the vice president of Weiss Ratings. Steve, I want to start with you. What was your initial reaction to QE2?
QE2. Actually, I expect it to come. I expect there's going to be more coming, Jamie. Bernanke, an interesting read that I would encourage the viewers to look at is that Bernanke wrote an article, was entitled What the Fed Did and Why We Did It. And clearly, he states out the premise for doing it, that he's going to try to inflate the economy a little bit more than it's been now. He doesn't like the level, it's a little bit too low. He says he doesn't want high inflation, but I believe he wants to bring us back well from the brink of deflation. He wants to take that option off the table. But also interesting, he talked about the wealth effect and how he was really, the second target was to gun for the investment markets, the stock market. His rationale was that if in fact the markets could go up, then the wealth effect would increase at the consumer level. Wealth effect would then give birth to a higher confidence level, and then higher confidence level would give birth to spending, and then higher spending levels would ultimately give birth to growth. And so he's saying, this is what I'm going to do, and this is why we're going to do it. And I think it's a great read, and certainly tells you the motive behind the actual man making the decisions. Whether we would want to agree with him or not, whether we like QE or not, we don't have that task. He has it, and like it or not, that's his rationale.
Okay, Mike, you knew it was coming. I guess we all knew it was coming. What is your take now that it's here?
Well, I think the size of the program was about what I was expecting, and I don't think it surprised the markets a lot. But I think, again, what people are starting to understand now is that Ben Bernanke is almost hell-bent on raising asset values, stocks and other things like that, and the side effect of his policy is to drive down the U.S. dollar. So I think in Bernanke's mind, what he believes this will do is to have a concrete impact on the real U.S. economy, employment and so on. But what I think it's actually doing is just helping to inflate asset markets.
And how is the bond market reacting, Steve?
Well, the long end of the curve has been pretty much backing off a little bit. You know, we got to a high, Jamie, on the 30-year, right around 109 and change. We're now back below par, that 97, 98, 99. There's good support around 98. So there's another good room to run. But he's announced the purchases. The bond market has now begun to move up in response to that. But I don't think it's going to move up as much as it did during that 09, that first wave. So we have some upside, but I think other bonds, will respond relatively better than just pure treasuries.
Mike, you agree? Where's the bond market going?
Well, I think the Fed can probably succeed at holding down short-term Treasury yields, like the yield on the 2-year Treasury note or even the 5-year note. But what the Fed is doing in the long term is actually helping send prices down and yields up. If you look at the 30-year bond, where concerns about future inflation are most register, 30-year bond yields have shot up since this QE2 talk came out, and bond prices have gone down. So I think what's actually happening is the Fed is indirectly pressuring things like mortgage rates up while claiming it's doing the opposite. You know, investors are so concerned about inflation at this point. There was actually a 5-year TIPS or auction of Treasury inflation protected securities where investors accepted a negative yield of 55 basis points. Why would they do that? Well, they're essentially saying they're willing to take a negative yield now because the principal value of those securities will be revised up as the consumer price index increases. That's how TIPS work. So again, their expectation is the Fed is going to create so much inflation that they'll get paid back later for accepting a negative yield now.
Steve, what do you think about that?
Yeah, I cannot believe that people are going to line up to take a negative yield. But you know, they did, and that's it. But interesting, in that comment that I referred to earlier that Bernanke wrote, he said he wanted to keep interest rates low for a couple of reasons. Number one, to stimulate the refinancings in the housing to allow people to reposition their debt loads. Number two, but he wanted to keep costs reasonable for corporations. And that tells me that the corporate bond market is going to do pretty good relative to treasuries. And also, there's going to be some more tightening, even in the high yield sector.
Okay, Mike, last question to you. How do you see this move affecting the economy and the markets going forward?
Well, again, I think the problem here is that the Fed is trying to impact the real economy, GDP growth, and things like employment. But what it's actually doing is just impacting the asset market. It's helping inflate the value of assets like commodities, stocks to some degree, and it's also helping drive down the dollar. I think ultimately that's inflationary and probably negative for the U.S. market. If you have unemployment elevated and you have inflation that's rising too, that's almost the worst of both worlds. So I think the Fed's not going to get the impact where it wants to get the impact, but it's going to have a lot of unintended consequences, both for the markets and the economy.
Okay, Steve, where do you think we're going here?
I think the same thing, but by the same token, from an investment standpoint, you know, when you have this Keynesian methodology that the Fed is using, essentially Keynes was a guy who felt that you could smooth out the dips in the business cycles, the highs and lows, by active government intervention. So clearly that's what we're getting. But I think that Mike's right. The asset inflation is going to continue to go. I don't necessarily think it's going to show up at the GDP level. But that means for investors, get aboard. The ride is going to happen. But by the same token, realize that Keynesian approach is flawed. And ultimately, fundamentally, it's still not going to work. But that doesn't mean we still can't make some good money in it. So in a way, tread out there, but tread lightly. If you're a fundamentalist, you're probably going to be disappointed. If you side up to the Keynesian side of things near term, you'll make some money, but you better keep an eye on the exit.
All right, Steve Chapman, thank you so much for your time.
Thank you, Jamie.
Mike, you stick around as well. We're going to be bringing you back after the break to get your take on the October jobs report, along with John Brown of Euro Pacific Capital. And coming up a bit later, our Picks and Pans segment will help you find the investments that are poised to benefit from the new political and economic environment. Plus, a closing comment from Martin Weiss. Money and Markets will be back in just a moment.